Yes, I'm here to share with you about the S&P Global's expectations or the recap for the financial industry over the past half a year. S&P Global posted that in a report that says global fintech industry funding fell 49% year-on-year in the first half of the year. According to a report released by S&P, global fintech companies received a total of $23 billion in financing in the first half of this year, down 49% year-on-year. On average, seed funding fell by 12%, early stage funding fell by 14%, and the growth and mature startups by 43% and 66%, respectively. The number of financings has also fallen sharply. In the first half of the year, the fintech industry completed 1,178 financings, down 64% year-on-year. Among them, the number of transactions in the second quarter was 522, down from 656 in the first quarter and down from 944 in the second quarter of last year. Investor enthusiasm for the fintech sector was waning. S&P Global noted that this was the slowest quarter on record in the last 2.5 years. The collapse of SPV in March was an event that further dampened investors' risk appetite. Mega financings larger than $100 million are also decreasing, 23 in the first quarter of this year, down to 9 in the second quarter, compared with 55 in the second quarter of last year. Stripe was one of the biggest winners in the first half of the year, closing at $6.5 billion funding round. Without Stripe's financing, the total would not have been able to exceed the $6 billion in the first half of the year, which was hit by the coronavirus pandemic, the report said. However, the valuations of the companies involved are still rising. In the first and second quarter of this year, companies were valued at an average of $9 billion and $14 billion, compared to $9 billion and $8 billion in the third and fourth quarter of last year, respectively. Recently, PitchBook released its second quarter fintech and payment industry valuation guidance. Shares of recently listed fintech companies rebounded faster than the broader market, rising 21.2% in the second quarter, while Nasdaq and S&P 500 rose 12.8% and 8.3% respectively. Over the same period, the data showed investors are currently prioritizing profitability, with traditional IPOs outperforming SPAC special merger and acquisition companies with an average gain of 21.2% and 13.5% respectively. Internet banking, insurtech, PropTech, and the high-growth payment companies are all struggling to be profitable, while well-funded traditional companies are looking for mergers and acquisitions, PitchBook said. A reset of the market also almost always favors strong companies. Companies that have seen stock prices rise over past year include Coinbase, Nubank, Robinhood, SoFi Oscar House, and others. PitchBook analysts James Long and Rudy Yan said, many fintech companies are focused on profitability and are therefore reducing personnel, marketing costs, and other operating expenses. Fintech companies such as internet banks are starting to see profitable business models. We expect investors to remain cautious in the near term and continue to look for companies on the path to profitability. The quarter saw a series of M&A transactions, including Robinhood's $95 million acquisition of X1 and FIS acquisition of Bond. The uptick in M&A activity suggests that lower valuations favor acquirer with sufficient free cash flow and cash. In May, it was reported that investor pessimism about financing fintech industry was near its peak. At the time, the fintech industry was faring worse, even taking into account the general decline in valuations of tech companies. However, the situation now seems to be reversing. That's all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.